Hello, everyone, and welcome to your first REIA Now update of the year. We're so excited you're here. If you will give us just a few moments to allow everyone to get in from the waiting room and settled, and then we'll begin. I was just saying to Rick, I'm so excited. This is my favorite event of the year. It's always amazing to have him here and to get us ready for what happens for the rest of the year. But we have a couple things before then. First of all, before I even get started, I wanted to say welcome, and I'm so excited for our new incoming president. Anish, wave to everyone, and if you could please take just a few moments to introduce yourself, please.
I'm beyond excited is an understatement. My name is Anish Tabe. I am president of the REIA down here in South Florida, in the Fort Lauderdale, Miami area. I guess we've been approved chapters for 13 years or so. I don't know. I feel like I should have got you a present, Rebecca. No, and as I joke around about all this stuff, so I'm so excited about what's happening and as a RIA to really take it to the next level and as we're starting to see all these changes, whether technology, environment, and real estate, and one of the things that I'm really kind of passionate about is I do want to get some younger folks into our RIAs, and we're starting to get a lot more young people in our RIAs, and I think that's going to be really beneficial for us old timers to learn something new from them and really start building these relationships around the country to really show that that we are a bunch of powerhouses, not to mess with us.
Well, we're very excited about having you. Anish has been very, very active for many years, giving us great direction, great advice. And so to have him in leadership right now is something we're all very excited about. There's new initiatives coming out. So stay tuned. You'll get to see all the good things as we go along. So um, thank you very much to Anish and BPM for allowing us to, and your lovely wife for allowing us to have your focus and attention for these next couple of years. So thank you. For today, I want to thank you as attendees for being here. We know you have lots of places that you could be, lots of things you could be doing, and we very much appreciate your spending your time with us. We're excited to bring you some great information, things that you can use to keep you ahead of the game for 2026. I can't even believe I'm saying that. We also want to thank, as always, the Home Depot Pro because they are our sponsor for this broadcast as well as many, many other things that we have presented throughout the year. They have special programs for investors that are available just through National REIA and our local affiliates. Things like discounts on paint up to 20% off, a great rebate program, and then some other exclusive programs that we have. You can find the information on that on our website as well as the local REIA's website. You can go there. I'll show you how to get to their information in just a moment. But first, I need to let you know a little bit more about us. If you're the first time joining us, our mission is to promote, to protect, and to educate. We've been around for over 40 years now. We just celebrated our anniversary. We have about 120 local chapters and over 40,000 members across the country. And we're so glad that you're joining with us today. If you are interested in joining REIA, if you're not already a member, you can do that by going to our website, nationalrea.org, and then you can click on I'm an investor. And then when you do so, you'll get these choices why join, which will give you a little bit more about us and what we do and how we can support you. Or then you can find a local REIA in your area. You can find something close. It'll show you a map view. Find something close to you that you're interested in. You can get all of our special programs through there and stay connected with us and your local group. Quick disclaimer, we're going to talk a bit about financial information and maybe even a little bit about legal information during our legislative update. None of that is actual advice. One of the things we do tell you is please build a team, and your team should include a great attorney, a great CPA, other financial advisors, and other things that you may need to support you in your investing journey. We are excited to have with us a few presenters today. We've got Jeremy with Quicket, and he'll talk to us about a new program we have that I'm so excited about, and how you can utilize that. We've got a legislative update with Kevin Coughlin, and we have our special guest, as I said, Rick Sharga, talking about what's happening in the market at the moment. So first of all, Jeremy, I'm going to let you take it away and talk about the exciting things that we are working on together.
Thank you, Rebecca. Can you guys hear me okay?
Sounds great.
First of all, look, I'm incredibly excited to be part of this call and to have the ability to be able to service each and every one of you on this call. I want to thank Lori, Rebecca, Karen for the support to enable Quicket, the platform that we have today, and for me to have the opportunity to be able to speak to you guys today. So my name is Jeremy Striz. I'm the Director of Single Family Solutions here at Quicket. I will be your single point of contact. On this slide, you can see my contact information. I would encourage everybody, please save my phone number, save my email address. You reach out directly to me, and I am going to ensure that you get a great experience in partnership with Quicket. So Quicket, what is cabinet refacing? First, I want to start with that. When it comes to cabinet projects, you really have three options. You've got the ability to resurface your cabinetry. You've got the opportunity for full box replacement. And then you have your third option, which we would like to think is your best option, is cabinet refacing. So where are we a good fit? In the event you do not need to change the layout of your kitchens, and for most of you all, what you guys do, that is not of interest to change the layout. If the boxes are structurally sound, that is also a requirement. Uh, those are the two main requirements. You don't change layout, boxes are structurally sound, we are a good fit. Where we are a perfect solution outside of resurfacing is if you've got old dated designs, if you've got damage to doors and drawer fronts, where putting a coat of paint on the exterior of those doors and fronts is not satisfactory for you to maximize your ROI or improve the marketability. That's where you want to partner with me and enable me to create a brand new, fresh look within your kitchen and/or bathrooms at a very, very appealing price point, which I'm going to touch on here in just a second with you guys. So when you think about Quicket, what differentiates us from everyone else in this space? Why is it so invaluable for National REIA to have a relationship with Quicket? I'm going to share really three things with you all as to what differentiates us from everyone else in the cabinetry space. First of all, we're fast. We are faster than everyone. You are guaranteed to receive your product within 10 business days at the time at which you order from us. And you also, too, are going to have access to an expedited option. This expedite option is going to allow you to trim your lead time in half for as little as $150 to $200. I had a customer on Monday this week. I helped place an order. They're receiving that order on Friday within 5 days. Pretty amazing. Then the installation. That's the other thing. So in addition to be able to receive your product in lightning speed, you're going to be able to complete the install within 2 days. This is really designed to be a consumer DIY project. If you have contractors that you sub your work out to, this is going to be an absolute walk in the park for them relative to full box replacement. It's going to save you a lot of money and time, money specific to the material procurement, but also too, it's going to be a lot less expensive on you from a labor standpoint. The easy part, everything about working with us is easy. I'm going to teach you how to order on your own. It's all self-service. I'll help you with your first order, but everything is designed to be customer self-service. Everything is designed to be incredibly intuitive. We provide you everything to facilitate a really smooth, efficient installation. And then one other thing that differentiates us from everyone else is if you're wondering where did the name Quicket come from and why, well, I just walked you through why the quick. The other part of that is we send all of your parts inside of my kit. It's a little briefcase. It's got a handle on it. It makes everything incredibly convenient and easy for you to receive your product, to move it from point A to point B. Everyone else in this space ships product on pallets, which is not convenient. You have to have a pallet jack. In a lot of cases, it'd be ideal that you have a dock to be able to receive it. With us, FedEx is our designated carrier. The average Quicket ranges between 3 and 5 boxes. So again, we set you up for a really, really easy experience from start to finish in the way that we fulfill our product. The last part, probably the one that's most interesting for you guys, is the affordable piece. Money talks. I understand, leveraging the bottom line and maximizing the ROI is incredibly important to everybody on this call. So this is really exciting. I'm gonna walk you guys through how much money we're going to help save you all. So you're going to be able to revamp your kitchen and or bathrooms for about 25% of what it costs to replace those boxes. There were just more tariffs imposed on full box cabinetry on January the 1st. It went to a 50% tariff. If you are not experiencing the sticker shock associated with buying full box cabinetry yet, you are going to, because every component associated with full boxes is not going to be shielded from these tariffs. With us, your pricing that Rebecca and Lori has negotiated that we're going to extend you guys is protected and is stabilized throughout 2026. So the price that I'm communicating to you right now will stay static throughout 2026. No price increases for you all. You are going to be able to completely refresh an average sized kitchen, which is about 40 parts, 70% doors, 30% drawer fronts, for $1,500 or less. So not only are we going to get it to you within 10 days, you're going to get an incredibly convenient experience in the way that you order and the way that you receive it. You're going to get a product that's got a lifetime warranty against delamination. No one else in the industry offers that. But you're also going to be able to do all that at an incredible price point of $1,500 or less for an average size kitchen. And on top of that, this is like one of those infomercials. It's like, and there's more. We're going to extend you guys. We have created a promo code for every one of you all as members to be able to save an additional 25% on your first order. So I've listed the promo code on the screen. Once I get you guys set up and you have an opportunity for your first order, I'm going to help ensure that you take advantage of that 25% savings. My intent with that is I just want everybody on this call to experience Quicket. I fully believe, and I have reason to believe this based off of experience, that when you use us for the first time and you experience us, it will just become customary and organic for you to default to Quicket for your kitchen and bath cabinet needs. So I am really excited about servicing you all. I would encourage anybody that's on this call right now, if you have an active project where you need to refresh your cabinetry, you're not changing the layout, the boxes are structurally sound, please reach out to me. I will take care of you. I will make it an enjoyable experience. I promise you. I'm just looking for an opportunity to service as many people on this call as I possibly can. So, Rebecca, that is it for me.
Jeremy, thank you. I'm so excited. Couple quick questions for you from the group. One, can they find a list of locations that you service?
We service everyone in the U.S.
Okay.
So anywhere throughout the U.S., lead time, our manufacturing facility is in Houston. So we ship everywhere throughout the U.S. The longest lead time through FedEx is 3 business days anywhere throughout the U.S.
That's awesome. And then if they want to change styles during this process, available to do so?
Absolutely not an issue whatsoever. So on that topic, we have 3 different door styles. There's a classic shaker, which is kind of the go-to for this industry. Property investors kind of gravitate to the classic shaker. There's the classic shaker that we have in 9 different colors. There is a shaker slide that's a little bit sleeker profile that we offer in 5 colors. And then there is the standard slab, which is one-piece construction that we have in our full color offering, which is 11 colors. In the event somebody wanted a color outside of our offering, we also have a paint ready option in all 3 styles that's primed. So you can order that, you can source your own paint, you can roll it, brush it, spray it, whatever you want to do in the event that you want a color outside of our offering. But the beauty about this for every one of you all is there is no discrepancy, there's no variance in pricing. Your price is your price. You can get any color, any style. It doesn't matter. Your price is your price. It's a per part pricing methodology, which just makes things very simple for you all.
Awesome. There are a couple people that have some specific questions. I'm going to ask them to reach out to you directly. So when you get this, you'll get this slide that has Jeremy's phone number, which he also has right in his um, profile right here on Zoom. You can see that right there, as well as his email address. Thank you so much, Jeremy, for being with us. We appreciate it.
Thank you guys. I appreciate you all.
Now I'm going to turn it over to Kevin Coughlin for our legislative update.
Hello, everybody. I'll be brief. I know everybody wants to get to our featured speaker. Um, Two things to put on your radar screen. I think I mentioned it last in December at our last meeting, but Andy Barr from Kentucky has dropped the Affordable Home Ownership Access Act, also known to us as Seller Finance Bill, which would eliminate origination fees for those of you who do seller financing and put you on an even playing field with the mortgage banking community. It has a bill number. It's a House Resolution 6511. And in the near future, after we huddle up with the Seller Finance Coalition, of which we are a member, we'll be asking you to mobilize and to participate when we see an opportunity for this bill to move forward. Given the nature of Congress today, uh, it is likely that this will have to be dropped into something bigger, uh, but it is a bipartisan bill and something that, and there is a bigger effort on housing affordability that is going on between the chambers. The Senate and the House are both working on their own versions of pretty comprehensive bills that would encourage new construction. A lot of emphasis on single occupancy, owner occupied property. However, there are some good things in there too for investors and for investment property. There's a lot of stuff we don't like, frankly, and I think that there's major differences between the House and the Senate on those points. And we're watching to see how those discussions fold out. If those go anywhere, they'll probably be dropped into the parts that they can agree on. Will be dropped into one of the spending bills that are coming up over the course of the calendar here in the coming months. Frankly, I'm not really optimistic that they're going to get there, but that would be a vehicle for Andy Barr's legislation, often introduced over the last several Congresses to finally get some action. And that would give us an opportunity to ask you to jump in and start firing up the phone lines and the emails to the key members in Congress to get it passed. The second thing I'll bring it up, I ring the bell every time I'm in front of you live and every time I'm in front of you on uh, this forum. Um, New York City just keeps giving us more and more material. And unfortunately, they give other cities around the country inspiration. Now, I don't really know that the policies that new Mayor Mamdani and his staff want to put forward will actually come to fruition. But some could, it's bleeding into the public discourse, which is where National REIA really comes in. And it's a perfect opportunity for us to talk.
Kevin, you accidentally just went to mute. So if we could try to.
Ma'am Dami is listening in on us and shutting me down. Just got throttled. Anyway, it's a perfect opportunity for this organization, for all of us as leaders in the investment community to talk about the fundamental value of private property rights in this country and to an advanced society and the benefits of private property rights. Not only the greater good, but frankly as a wealth building mechanism, which is something that we should all be in favor of. This new tenant rights advocate that he has hired has some very interesting views, very recent views, and with regard to the appropriation of property and moving things over to state-owned property. Again, I can't imagine that those things would be implemented in New York, but the more and more they are boldly proclaim these things, the more you might see these things spreading, these ideas spreading around the country. So something for us to keep an eye on, and I think step into the unique role that we have to fight against it. And really, it shouldn't be a hard fight. This is most people are very much in favor of private property rights. It's a fundamental part of the fabric of our country. And we shouldn't have a very hard time defending it, but somebody has to give a voice to that argument.
Thanks so much, Kevin. And then
Yep.
just to let you know, we cover on a really regular basis um, on realestateinvestingtoday.com many of the things that are happening there. Brad does an amazing job of giving you all week. Literally, there's a post every day of industry updates, industry info that you can find and easily access. Spread the word. We love for you to share that. That's what it's there for, to keep your people informed as well. So thanks to Brad, and just a reminder to all of you to stay informed, and we'll keep getting that out there for you.
Rebecca, can I just 30 seconds real quick put a little specific point on what I just said? Because one of the things that this person in New York City is proposing very recently, this is not conspiracy, she said this, it's out there as stated policy, is kind of what I will call a two-step. So it's not so much we're going to take your property and it's going to be city run. It's we're going to do rent control and we're going to make it very difficult for you to invest in the property and maintain it. And then over time, we're going to come in and say, well, you're not meeting your obligations as a landlord, and then we're going to take your property. That is, uh, and I'm not putting words in her mouth. That is what she has put forward. So this rent control two-step that we may see materialize here in New York City and other cities.
Thanks for the clarification, because that is a really big deal. And that is oftentimes how policy gets implemented, is in steps. It's the boiling of the frog, right? A little bit at a time, and therefore hopefully less of a fight. So it's important for us to stay informed, to stay updated. We will do the best we can to keep you in the loop and to keep you updated on all the things that are happening. Brad just posted in the chat one of the most recent articles that he has put up on real estate investing today. We're seeing a lot of things come out of even the Wall Street Journal, that lots of opinion articles on that. So it's a very, very hot topic of the moment. Speaking of which, I'm curious to see then how that affects anything with the upcoming projections or things that you're seeing, Rick, in any of the data. Is any of that fear kind of playing out? I'm very excited to see all the things that you have for us today. So instead of talking too much, I'm just going to say thank you. You're the best. And I will let you then take it away with 2026.
Well, thank you very much. We'll jump right in. We have about a 3-hour presentation that we're going to go through in the next 40 minutes or so. And we're going to cover a lot of that. The other thing, I'm surprised, and maybe you've covered this before. I don't know if Kevin has any particular insights on this, but the proposed ban on corporate entities buying any residential properties. I've come out against that pretty strongly. I think it's a terrible idea. And uh, it also gives me great fear in terms of how the federal government defines what a corporate entity is. I've heard numbers as low as owning 25 properties suddenly turns you into Blackstone, which is a kind of a nice trick. But something else to keep an eye on. And we'll talk a little bit about that as we get through parts of today's presentation. We are going to cover a lot, so I'm going to jump right in. I'm going to talk about what I'm seeing in the U.S. economy right now, what we saw in the 2025 housing market. We'll take a quick look at investor activity to tell you what your peers are up to these days, and share some thoughts on an outlook for 2026. I will tell you that two of the slides that I just sent to Rebecca and Lori last night, we've had new data come out on this morning, which just is the way the world works sometimes. We'll talk a little bit about the updates as we get into them, but we'll run right through. So what's going on in the economy? Economists keep telling us how bad the economy is going to be, that growth in the economy is going to slow down to a crawl. And in fact, if you look at the chart in front of you right now, that blue area on the bottom left-hand corner is kind of the consensus of what most economists have been projecting in terms of GDP growth. GDP is our gross domestic product. It's the size of the economy. It's kind of shorthand that economists use to tell you whether the economy is growing or contracting. And at a sub 1% growth rate, it would be a pretty weak economy. The Atlanta Fed does a real-time analysis of what's going on in the GDP. And their most recent number, they had it decline actually from about 5.4% to 5%, which would be the highest quarterly growth we've seen in the GDP in quite a long time. So, and this has been pretty consistent throughout the course of the year. If you were to look at the prior several quarters, we had a negative quarter of growth early in the year, and that was because there was an enormous amount of import activity going on as companies were trying to get inventory into their locations because they were afraid of what might happen with tariffs later in the year. Most of the economists who have been projecting what 2025 was going to look like were baking in a much higher rate of inflation, a much weaker economic growth, again, partly because of the proposed tariffs. None of that has come to fruition. We've had three consecutive quarters where the growth has been stronger than anticipated, and it continues to be pretty strong. The one caveat I will give you here, we'll talk about this a little later in the economic part of today's discussion, is our economy is very largely driven by consumer spending. So about two-thirds of the economy is based on consumer spending. So when we see the GDP going up, it usually indicates that consumers are spending a lot of money. The real estate portion of the GDP is a significant share as well. Government spending, business investment, but that consumer thing is pretty important to keep in mind. Elsewhere in the economy, the stock markets took a little bit of a dive back in April on Liberation Day, I think that the administration called it, when all these potential tariffs were announced. But since then, they have recovered in a big, big way. All three indices, as of yesterday, I haven't looked at the numbers today, but as of yesterday, were either trading at or near all-time highs. The S&P 500 and the Dow in particular were both trading at the highest levels they've ever traded at. So the stock market has clearly shaken off its tariff tantrum and is doing pretty well. Now, what goes on Wall Street doesn't necessarily reflect what's going on Main Street, but if you look at two metrics that economists typically look at to gauge how well the economy is doing, these two are doing pretty darn well. Elsewhere, inflation, and this is one of the numbers that changed since yesterday. Inflation, the most recent quarter, the most recent month we had was the month of November, and the CPI, the core inflation rate came in at about 2.7%, which was lower than what economists had been forecasting. And interestingly, one of the highest areas was energy, which is something the administration has been focusing on getting prices down on, and touts lower gas prices this year compared to a year ago. That 2.7% rate was down from about 3% the month before. It is trending in the general direction that the Federal Reserve is looking for. And today's announcement came out and it held steady at 2.7%, which was lower than the 2.8% that economists had projected. So inflation has really settled down. We're not down to the Fed's 2% target rate. I put the chart on the right just to kind of give you an idea what things look like historically when we're talking about inflation. And the point to keep in mind here is if you go back as far back as you can go in inflation, and those numbers go back 50 or 60 years, depending on whose numbers you're looking at, the average rate of inflation in a given year is usually between 3.3 and 3.5%. So even though we're not at 2%, we're still below the long-term historical average in inflation, and that's something that very rarely gets reported in the press. So if you're really looking for kind of historical context on this, inflation is doing better than forecast and better than historical numbers, even though it's not down to that 2% rate that the Fed would like. The other thing to point out here, and this is also important contextually, we'll get to consumer sentiment in a minute, which has not recovered particularly well. And I believe that's due to cost of living being as high as it is, and a lot of households kind of living on the margins. That's not a reflection of today's rate of inflation. That's a reflection of the huge lift we had in inflation a few years ago when inflation was running at the highest rate we'd seen in 40 years, over 9%. And today's rate of inflation is much lower, but that doesn't mean that prices are going down. It just means they're going up more slowly. So households are still trying to dig out of that hole that they dug into when inflation was kind of out of control a few years ago. And that's why there's so much focus on what the inflation rates actually are. Um, the most recent unemployment numbers came in a little bit lower than the prior report. They're down to 4.4%. Um, that's not as high as the Federal Reserve had anticipated for the end of 2025. They were looking at unemployment being as high as 4.8, 4.9%. So better than they had anticipated. Historically, again, anything below about a 5% rate of unemployment is considered to be pretty much full employment in the economy. So at 4.4%, we're actually doing pretty well. There aren't a ton of layoffs or firings going on. And that's a positive in the economy. But we're in a very weird economic period right now where there's very little hiring, as you'll see in a minute, but there's also very little firing or laying off. It's almost like employers are kind of frozen in place. We're also seeing lower job quit numbers than we usually see, which means that employees are kind of tentative and want to hang on to a job rather than go look for something else because they're not sure. One of the potential red flags we're seeing in the unemployment numbers is the chart on the right. We're starting to see once people lose a job, it's taking them longer to find their next job. So the percentage of unemployed folks that are looking at 15 to 26 weeks of being unemployed is actually kind of increasing, not at an alarming rate, but it is going up. And so that's something to keep an eye on as we move forward. Again, a lot of our economy is built on consumer spending. If consumers aren't working, they're not earning money, and so it's difficult for them to keep spending. I mentioned that not a lot of people are hiring. So job growth remains weak. The most recent number that came out for, I believe it was November, was that we added about 50,000 jobs to the economy. That, historically speaking, and given a population of our size, is a very low number. So job growth has been very weak this year. The October number looks crazy bad. We lost 173,000 jobs. Um, Again, maybe not something you saw reported a lot, but about 180,000 of those jobs were federal government jobs that were government employees who took advantage of the 10-month severance program that the administration put in place in January, where they gave employees an option to stay on for 10 more months as a severance and then no longer be on the government payrolls. Government payrolls are down, federal government payrolls are down almost 300,000 year over year through November. The prior year through the same period of time, they were up by six figures. So a huge, huge swing in the jobs market just based on the federal government numbers alone. And I believe, and this is something that I'd have to dig way deeper into the numbers to be able to prove or disprove. I'm not sure I could even do that, but my belief based on logic is if you eliminate 300,000 federal government jobs, you're also going to eliminate a lot of what I call government adjacent jobs, contractors or companies who are getting assignments from the people who have left the federal government. So I do believe that's one of the reasons that job numbers were as strong as they were the prior year, because there was a lot of federal money going into propping up the jobs market. And one of the reasons that the jobs numbers are as weak as they are this year. There's also probably, again, a little bit of trepidation about the impact of tariffs. But again, that really hasn't played out the way most people were afraid it would. Hourly wages have not gone negative, despite what that chart on the right looks like a little bit. They just dipped down to a little bit over 3.5% on a year-over-year basis. They've recovered to about 3.8%. They've been averaging somewhere in the 4 to 5% range for the last few years. And even at 3.8%, keep in mind that means that wages are growing at a rate that's significantly ahead of the rate of inflation. And that's a good thing over time. It gives people a chance to kind of catch up. We've also seen a significant increase at the low end of the wage scale. We've had some states that have mandated increases in minimum wages. And so people at the lower end of the wage scale for the first time in a while have actually been seeing an improvement in their wages. With all of that, and I really do believe this goes back to that cost of living thing I mentioned a few minutes ago, consumer sentiment remains near an all-time low. That's the chart on the left. If you take a look at that inset on the chart on the left over the last 12 months, you can see that in the last 2 months, we've started to rebound from what was an all-time low, and we're starting to see consumer sentiment improve a little bit. On the other hand, the consumer confidence index continues to drop down a little bit. And the difference between these two charts is the sentiment index is kind of based on household expenditures. What does it cost me to buy the things I need to run my household? The consumer confidence index has a lot to do with jobs and wages. So consumers are not feeling as confident about their jobs, but they are feeling a little bit better about what they're seeing at the grocery store when they have to pay the rent every month. So it's a tale of two different ways of looking at consumer confidence. Neither of them are particularly positive right now. I know it's one of the things the administration complains about is that what most people are reading is continuing to be negative. But I think the reality is people are looking at the jobs market. They are looking at their monthly expenditures. And one of the reasons for consumer sentiment and confidence being a little bit weak is that consumer debt is at an all-time high. So if you go to the end of the third quarter, which is the last time this data was published by the New York Fed, consumer debt was at a record of $18.6 trillion, highest again that it's ever been. Now, about 70% of that is mortgage debt, which is offset by about $36 trillion in homeowner equity. So that's considered reasonably safe, but we're near all-time highs in terms of credit card debt, at a little over $1.2 trillion, auto loan debt, student loan debt, other types of consumer loan debt. And for all of those loan types, interestingly, with the exception of mortgages, we're seeing delinquency rates go up. So total delinquencies in terms of consumer credit have gone up for nine of the last 10 quarters and are now approaching pre-pandemic levels. So part of this is what economists will call reversion to the mean. We're getting back to more normal levels, but it is trending in the wrong direction. And if you were to look at the one I keep my eye on the most really right now is student loan debt. Student loan debt wasn't reported as being delinquent or current until January of 2025. And since then, the delinquency rates have skyrocketed. And this is a problem in the housing market in that what we're seeing in terms of mortgage delinquencies, much higher rates of delinquencies from homeowners who have a student loan than homeowners who don't have a student loan. And there's a chance now with some of these loans being 10 months delinquent. That's the magic time period when the federal government can start garnishing wages for people with student loans who are delinquent. That average garnishment would probably be somewhere in the neighborhood of $700 to $800 a month, which will make it difficult for current homeowners to make their monthly payments, and will make it difficult for non-homeowners to be able to save up money for a down payment on their home. So just some things to keep in mind. And I believe, again, this is one of the reasons why consumer sentiment is as weak as it is. We've seen credit card balances kind of roar up. We've seen savings rates decline. And that suggests to me that a lot of these households are having trouble making ends meet and are tapping into credit lines or tapping into their savings in order to do that. We've seen this movie play before. It doesn't have a particularly happy ending, so it's something we are keeping an eye on, even as the economy continues to grow and unemployment remains low. What's going on in the housing market? First thing to look at again is affordability. And affordability is still a headwind. It's not good by any means, but it has been improving in recent months. And that's some of the first good news we've seen on the affordability front in quite some time. This is a chart from the Atlanta Federal Reserve, and they take a look at what percentage of household income it would take in order for somebody to buy a median priced home with a 20% down payment and still only spend 30% of their monthly income on housing. The index for affordability to be strong is 100. Right now we're at about 69 on that index. But interestingly, the median monthly payment in January this year is down about $100 a month from where it was a year ago. That's not reflected in this chart, but this chart is showing the general trend. The last couple of months from the Atlanta Fed, that index has been ticking up ever so slightly, but it's been ticking up. So it's at least moving in the right direction. One of the main reasons affordability is getting better is mortgage rates have been coming down. Even before some of the announcements in the last couple of weeks, mortgage rates are almost a full point lower than they were a year ago at this time. That doesn't make things affordable for everybody, but it does make things more affordable for more people. And candidly, it looks like the market is kind of getting used to mortgage rates around 6%. The administration's announcement last week that it was going to have Fannie Mae and Freddie Mac buy about $200 billion of mortgage-backed securities did seem to have the effect that they wanted it to have, in that the spread, and when economists talk about a spread, they're talking about the yields on 10-year U.S. Treasury bonds and the interest rate charged on a 30-year fixed rate mortgage. And those two tend to run in concert with each other. And there's usually a spread, a gap of about 1.5 to 2 points between those two. So if Treasury yields are coming in at 4%, your mortgage rates historically would be somewhere between 5.5 and 6%. Coming out of COVID and when interest rates started to really skyrocket, we saw that spread jump over 3 points at one point in time. The announcement last week caused the spread to continue to contract a little bit. And I could see a scenario where the spread improves enough, getting back to normal levels, that we start to see mortgage rates down in the high fives, the 5.75 to 6% range as we go through 2026. We'll see how all this plays out. The other thing that could result in mortgage rates coming down a little bit really has nothing to do with the Federal Reserve cutting the Fed funds rate. It has more to do with two potential things that could happen. One is we could see the economy slow down, and if the economy slows down and unemployment goes up, typically you see mortgage rates come down in that scenario. That's not a pleasant scenario, but something to keep an eye on. And that means for people that are employed or people that have cash to purchase properties, you're in a better position to do so in that scenario. The other thing that could happen, and this would be a miracle, given both political parties' inclinations, is we could see the federal deficit come down a little bit. That would be really, really wonderful. I am not predicting that here. In fact, I'm predicting just the opposite. The one thing that both presidential candidates agreed on during last year's election was that they both wanted to spend more money. And I think most politicians seem to be inclined to do that. But that's one of the reasons bond yields are so high. The bond market knows that the U.S. Treasury would have to issue more bonds in order to pay down the federal debt. Paying down the federal debt right now is the third largest item on the federal budget. We're actually spending more to pay down the federal debt than we're spending on the military. It's a crazy number. And so anything we can do to get the federal deficit down, the federal debt down, would cause the bond markets to kind of relax a little bit. And we'd see bond yields come down, and that would drive mortgage rates down. Anyway, enough about that. The fact that mortgage rates have come down a little bit has driven a lot of buyers back into the market. So the Mortgage Bankers Association reports that the purchase loan applications, the number of people applying for mortgages to buy a house, was at the highest level it's been in 3 years. Not as high as it was back in 2020, 2021, or even early 2022, but moving steadily in the right direction. This is another reason I believe that people are starting to get used to these mortgage rates at that 6% range. We got through the sticker shock at 8%, 7%. But the inflection point that I really believe we'll start to see people coming back in earnest is once we get down below that 6% threshold. The other thing that's causing home price affordability to improve is that home prices are going up much, much more slowly, and in fact, declining in some markets. This is the last data available from both the Case-Shiller Index and the FHFA, which is the government organization that controls Fannie Mae and Freddie Mac, about 65% of mortgages that are out there. And in the FHA book of business, on a year-over-year basis in September, as they reported in October, home prices only went up 1.7%. That's below the rate of inflation, and that's below the rate of wage growth. So that's a big component in terms of affordability. And you can see that certain areas in the country, the Pacific region, the Mountain region, West North Central, which is kind of the Plain States area, all of those regions, not the West North Central, the West South Central, all those regions actually saw prices go down on a year-over-year basis. So this is important from an affordability perspective. The Case-Shiller Index reported similar numbers. I think their annual increase was about 1.4%. So you probably still see people on YouTube screaming about the coming home price crash. I would encourage you to just click past those channels, as they're probably selling you really expensive programs telling you how to take advantage of the crash, which isn't coming, by the way. We are not going to see a home price crash. When mortgage rates doubled back in 2022, I said that one of two things was likely to happen. Either one, we would see a home price crash, or two, we would enter a kind of long, boring, and difficult reset period. And I was gratified to hear a bunch of economists at the end of 2025 start using the reset word. And what I meant by that was it was going to take a while for the country to adjust to these higher home prices and higher mortgage rates. And what we would see is home sales slow down and then home prices slow down. And gradually we would see some of these 3% mortgages replaced with 6.5% mortgages. And now, for the first time in several years, we actually have more homeowners with a mortgage rate above 6% than we do with mortgage rates 3% or below. So this reset period is happening. I believe the year 2025 ended on a positive note in terms of home sales. And I think we'll see some of that momentum carry into 2026. 2026, I think, will be kind of the inflection point year in the reset, and 2027 will be the first year that feels like a real recovery. So I do expect home prices to be very weak this year. They'll be up nationally by a fraction, and probably there will be markets that will continue to see corrections as we go through 2026. Some interesting information from Altos Research published by the chief economist from Compass. If you look at the percentage of listings that took a price cut before the property was sold, we were running at about 45% at the end of 2025. That's much higher than normal. It's the highest year we've seen since 2022. And remember, 2022 was the year when mortgage rates doubled in the second half of the year, so people kind of had to cut their prices. We entered this year at about 36%. So in a normal market, about a third of all listings get a price cut before they're sold. And it varies from a seasonal perspective. But that 36% is certainly better than we ended last year with. And it'll be interesting to see what happens as we go through the course of the year. Anecdotal information suggests that list prices started this year a little lower than they did last year, which is the first time that's happened in a long time. And it could be that sellers are starting to get a little bit more rational as they're pricing these homes. It's important as an investor to remember that the national numbers say one thing, but your local market numbers say something very, very different. And regional price variations continue. If you're looking at the Gulf Coast states, you're looking at places like Austin, where prices went crazy during COVID, or Phoenix, where prices went crazy during COVID. You're seeing prices in November that were down 6% and 3% year over year. The Gulf Coast of Florida, places like Punta Gorda and Cape Coral, had double-digit price declines year over year. If I were to show you this map and show you what home prices have done since 2019, even those markets where you saw prices come down last year still showed significant growth during that 5 or 6 year period. But the prices are retreating from what those record highs were. In the meanwhile, areas in the Midwest and Northeast are still seeing prices grow. Hartford was up over 4.5% year over year, Detroit 3.5%, Milwaukee 4.5%. And so we are still seeing regional variation. So it's really important for you as an investor or a lender to understand what's going on in your market, and adjust your plans accordingly. Be careful not to catch a falling knife in markets where prices are going down. But if you know your market well enough, also know when it's the right time to buy on the dip. And again, it really behooves you to know what's going on in terms of your market pricing. A lot of that pricing is driven by inventory. The more properties available for sale, typically the lower the price increases are. And there's a pretty strong correlation. We did see the number of properties coming to market either flat or growing virtually everywhere across the country in 2025. And that's the map on the right. but they didn't grow as fast as they did from 2023 to 2024. And that's the map on the left. So you can see again, Florida, Georgia, the Carolinas, parts of the West Coast, Colorado and Denver, Phoenix. We had very strong inventory growth in those markets in 2024, slowed down a little bit in 2025, but we are continuing to see inventory grow on a year-over-year basis. It's up about 13% in January this year compared to where it was a year ago. It's up about 16% as of December compared to the prior Decembers. And again, it varies across the country, but as of the end of November, we were back to pre-pandemic levels of inventory of homes for sale in 17 states across the country. And you can see how that breaks out in a metro area. The markets I was telling you where prices are growing most quickly, look where they are and remember where I showed you prices growing most quickly. It's the Northeast, it's the Midwest. So prices are growing more quickly where inventory continues to be constrained. Prices are declining or flattening out more in markets where those levels of home inventory are accelerating or are above where they were prior to the pandemic. So you look at states like Arizona, and Texas, where in both cases there's 30+% more homes available back in 2019, Washington State at 25% more, Florida 23% more. So take a look at what's going on in terms of local sales to predict what's going to be happening in pricing. And the economics we talked about earlier, I always tell investors to look for three things in their housing markets: to look for population growth, to look for job growth, and to look for wage growth. And if all three of those are positive, you're probably going to have a good market for real estate, whether you're talking about owner-occupied properties or rental properties. If you see any of those declining, uh, take a really hard look at what you're planning to do in that market. The more inventory you have equals a longer sales cycle. So your days on market increases. This changed this morning too. I was looking at November numbers from Realtor.com. They were showing a median number of days on market across the country in November at 64. This morning they increased that to 72 as of December. But these numbers vary wildly depending on where you are in the country. Most recent numbers I looked at in Illinois, it was about 82 days on market. In California, it was 36. So understand what's going on in terms of days on market. But the longer these properties stay on the market, two things happen. One is it inflates the inventory numbers. So the inventory growth we're seeing is mostly not because of new listings. It's mostly because once a property hits inventory, it stays there longer. So that makes those inventory numbers go up a little bit higher than they were a year ago. The other thing is it puts more price pressure on sellers. So if your property's been on market 60, 70, 80, 90 days, you are feeling some pressure to negotiate that price in order to get that transaction done. Or what's happening more and more frequently is we're seeing a record number of delistings. So Redfin reported that something like 38% of properties listed in the last quarter were delisted. So the seller just wasn't getting a price they liked. They didn't need to sell. That's one of the reasons we're not going to see a price crash. If you go back to 07, 08, when prices did crash, it was because a lot of people needed to sell with whatever price they could get. But if you're sitting on a 2.5% mortgage and you have a bunch of equity in your house and you don't have to sell it, if you don't get a price you like, you're not going to sell it. So that forced selling is one of the things that tends to lead to price declines. We're just not seeing that. And we're certainly not seeing sellers panicking into distressed pricing. The other thing that tends to lead to distressed pricing is people that are in foreclosure, and foreclosure activity is running somewhere between a third and a half of normal levels historically. So we're just not seeing a lot of people who have to sell because they're in foreclosure either. In a market our size, traditionally, somewhere between 500 and 700,000 people would be in foreclosure. Today's number is about 225. So there's still people that are in foreclosure. A lot of them have equity. So rather than losing a home to a foreclosure auction, they're listing the property and selling it on the open market. So very, very different set of scenarios, market dynamics than we had going into the home price crash. But the median list prices We're still trending up a little bit year over year as we got into November. They started to come down in December. And again, preliminary data I've seen shows that January list prices are a little bit lower year over year. But that list price to sale price ratio, very, very strong. The median discount we're seeing generally is less than 5%. So it's not a huge decline in home prices. The market really has moved, and this is from Zillow Research. The market has moved into a neutral territory. We have about a 4.6 month supply of homes on the market. Most housing market analysts will tell you that inventory levels below 4 months are strong for sellers. Inventory levels from 4 to 6 months tend to be neutral. And inventory levels above 6 months tend to favor buyers. So we've gone from one of the strongest seller markets in history into a more neutral market. It does vary depending on where you are in the country. We again still see some pretty strong buyers markets in the Gulf Coast and some of the Southeast markets. In some pockets, other areas, the neutral market is spreading. We do have some pockets of strong sellers markets. Again, Northeast very predominantly, and some strong sellers markets as well. I think Connecticut, where we saw prices go up, and where I am here in Southern California are two of those markets where we still have some strong seller opportunities. Meanwhile, actual sales seem to be improving. The pending sales index in November improved for the fourth consecutive month. This is something the NAR puts out. It shows contracts that have been entered into, but the transaction has not yet been recorded. It tends to be a pretty good predictor of what you're going to see in the next 30 to 60 days. Now, a good index would be 100. So we're still nowhere near where we need to be in terms of a kind of robust housing market. But 4 months in a row of improvements is still moving in the right direction. And the South in particular is seeing a fairly strong pending home sales index. And it's approaching that 100 record, that 100 metric rather. The Midwest is doing pretty well too. And again, a pretty decent sellers market there, but there is continuing demand, and people do continue to move from higher price markets to lower price markets, and that does benefit the Midwest and the Southeast. Existing home sales, we had the fourth straight month where we sold more properties than the month before, again, trending in the right direction, at about a 4.13 annualized rate in terms of 4.13 million units sold. That would be an improvement over the prior year at 4.06%. November sales actually were a little bit lower than the prior November, but by that much. And preliminary reports in December look like we're going to be above both November and above last December's numbers. So again, closing the year at a pretty positive trajectory. Median price is still increasing, but only by 1.2%. According to NAR in November. Still, we've seen increases now for 29 consecutive months, and that doesn't seem likely to change anytime soon. But the rate of that increase, if you're only increasing at 1.2% and inflation's at 2.7%, that means the house is actually cheaper than it was a year ago if you look at inflation adjusted dollars. So again, trends moving in the right direction, both in terms of sales and in terms of pricing. And if you look at total existing home sales on a year-over-year basis, just a slightly different way of looking at that. But we're on pace to end the year somewhere between 4.1 and 4.2 million homes sold, existing homes sold. That would be an increase from the prior year. And again, would be an indication to me that that reset period is nearing the end. We'll have another kind of weak-ish year in 2026, but it'll improve as the year goes on. And we can look for really more of a recovery in 2027. This is one of the other numbers that changed this morning. August new home sales were the last month we'd seen reported. I've been saying for a long time now the numbers look like an aberration. We went from about 660,000 annualized sales to about 800,000 in 1 month. Everybody who follows new home sales knew that number was wrong. And we got adjusted numbers out today. I haven't seen the August adjustment yet, but I can tell you that September and October both came in around 735,000, which is still a really good number, and actually above what most of us had anticipated this year. Also, a much higher percentage of new homes as a percentage of the total home sales. Usually they're somewhere between 10 and 15%. If they finish the year around 730, 750,000, they're going to be closer to 20% or more of all home sales. We do know that some investors are buying investment properties from new home sellers, mostly for rental properties, as the sellers are kind of closing out, as these new home builders are kind of closing out their inventory. So keep an eye out for those kind of opportunities. They also very often offer advantageous pricing and financing. So it probably not a great fix and flip opportunity, but could be an interesting opportunity for rental property investors. Housing starts are not great, but the builders are working through a backlog of homes that are under construction. There's about 122,000 homes under construction nationally. That's relatively high for them. They'd like to get that narrowed down a little bit before they start anything else. But permits, starts, and completions were all down year over year in October. So we're not going to build our way out of the housing shortage we've had, but the builders are being very careful not to repeat the mistakes they made back in '05 and '06 when they actually had an oversupply of homes coming to market. So this is not a sign that they're not going to build. It's just a sign they're being very circumspect about not getting too far out over their skis. And I know we're at the top of the hour, so I'm going to kind of go through this quickly. But if you look at investor activity, this is a report I actually put together working with a company called Batch Data in the third quarter, second quarter of 2025. Investors purchased 33% of all the residential properties that were sold. That's the highest number in at least the last 7 quarters, and could be one of the highest percentages ever. I will give you a sneak peek. We're releasing the fourth quarter, third quarter data this week. The number went up to over 34%. And that's even though investors actually purchased fewer homes than they did a year ago, but it just shows you how weak the traditional home buyer market is. So investor share of market went up, even though their total purchases went down slightly. So really interesting market. Most investors, this is from a survey I do with RCN Capital on a quarterly basis. Most investors buy properties in their own states, and most of the investing takes place in the most populous states. If you were to look at California, Texas, Florida, North Carolina, and Georgia, those 5 states alone account for over a third of all investment properties that are owned by both small and large investors. Investors do own about 20% of all single-family homes across the country. That ranges from a low of under 10% in Minnesota, which is probably a great place to avoid right now anyway, to over 30% in places like, and you're going to be surprised at some of these, Maine, Montana, Alaska, and Hawaii. And I made the same face Rebecca did when I first did this research, and then dug into it a little bit. And it turns out all 4 of those states are very heavily dependent on tourism as part of their economy. So a lot of those investor-owned properties are owned by investors that own 1, 2, 3 properties. And these are vacation rentals. They're short-term rentals like Airbnbs and Verbos. But that's why the percentage of homes owned. And I looked at California data. I live in California. There were a couple of counties where 70% of homes were owned by investors. And I thought that has to be wrong. And then I'd look at the county, and it was a place where there was very low population, very low number of homes, but all the homes were there for tourist purposes. So it's kind of bizarre how that works. But there are investor-owned properties everywhere you go in the country. And most of them, the overwhelming majority of them, are owned by small investors. This is why the whole movement to ban corporate investors is so goofy. It plays well politically because nobody ever lost votes by saying they're going to go out and slay the Wall Street dragons. But they slay this dragon and it ain't going to rescue the princess. The 91% of investor-owned properties are owned by people who hold between 1 and 10 units. If you look at all of the big investors who own 1,000 plus, they own collectively only 2% of all investor-owned properties. They own collectively less than 0.4% of all residential homes. So it's a popular narrative that, Wall Street's gobbling up Main Street, but the numbers simply don't support it. And in the third quarter, in the third quarter, again, this hasn't been released yet, but in the third quarter, there were over 1 million residential properties purchased in the country. Of those million, 4,600 were bought by institutional investors. It's a rounding error, wouldn't have any impact on home prices. And it's not a competition with first-time buyers. Most of those properties are properties that home buyers wouldn't want to buy because they require a lot of work. And by the way, those same investors who bought 4,600 properties sold 5,800. So for the seventh consecutive quarter, they've actually sold more properties than they bought. They're diverting a lot of their capital into building rental communities, ground up rental communities of single family residential units. And so it's just kind of a false narrative. This shows what I was talking about going back from the first quarter of 24 through the second quarter of last year. And again, every quarter they've been selling more than they're buying. Meanwhile, flipping activity is actually down for the fourth time in 5 quarters. There's some data from Adam, and it really shows how difficult a market it's been for flippers. As affordability has been really challenging and inventory has been limited. So the kind of inventory you'd like to buy, the distressed inventory at lower prices that needs a lot of work, just really hasn't been out there for the last few quarters. And affordability has been difficult for the people looking to buy these properties from flippers. I am led to believe that we're actually kind of bottoming out in the flipping market and that conditions are improving for flippers. Again, some survey research I've done. Flippers are much more optimistic about the next 12 months than they've been over the last 12 months. But if you're wondering why it's been slower, it's because a lot of the margins that flippers are used to getting have been challenged. We're looking at about 6 consecutive quarters where margins have been compressed, and that again has been because of affordability issues. Home prices continuing to go up on a purchase side, but your inability to make enough of a margin on the resale. Meanwhile, if you're a renter, if you're a rental property investor, we've seen apartment rents actually go down year over year. Single family rental properties have kind of held their own. They're up about 1%, a little more than 1% on a year over year basis. It varies wildly by market, and you can see in the data that different markets the prices go up. But we are still seeing whether it's detached or attached, whether it's at the high end of the market or the low end of the market, single-family residential rentals have held their rental prices better than apartments have year over year. And partly because of all these variables I've talked about, some other research I've done shows that about 30% of people who traditionally flip have actually shifted at least short-term into buying properties and renting them. And there are a whole series of different things to consider in your investment strategy, like soaring insurance premiums and property taxes that we really haven't talked about and probably won't have a chance to get into. This just shows again some survey research from something I do with RCN Capital. Market conditions have driven behavioral changes among investors, whether it's reducing their sales prices or rental prices. They've scaled back investing. They expect changes to be forced on them. And as I mentioned, a pretty significant number of flippers have shifted from fixing and flipping properties. 52% of flippers have shifted from fixing and flipping properties to hanging on to these properties as rentals. Most of rental investors have remained solely percent in that business. But it's just a kind of a snapshot of the market reality and what that's happened. And I mentioned insurance costs and availability. About 77% of the investors we surveyed are now considering insurance as part of their decision on whether or not to invest in properties, and over half of them have lost at least one deal because of insurance issues. So something to really keep in mind as you're looking. And again, if you'll have these slides, but in Florida and California, about 100% of investors are looking at insurance as an issue because it's become such a problem, both from a pricing standpoint and an availability standpoint. So sorry, I ran a little bit over. I mentioned that the year closed in a little bit of positive territory. This is some January data, the first week of the year. Home sales were up from a pending sales perspective, almost 2% from a year ago. If we held that number for the rest of the year, we'd be looking at home sales somewhere in the 4.4 million range, which would be, 2 consecutive years of increase. So keep your fingers crossed. This is some estimates again from the chief economist at Compass based on what he's seeing in Altos research. He's looking at last year being up almost 2%, this year His forecast is about 4%. And he said, in a Goldilocks scenario where the economy does certain things right and home prices do certain things right and mortgages come down just enough, you could see it go up by 10%. I'm not buying into Goldilocks right now. Realtor.com is only expecting about a 0.5% growth in sales volume next year, but again, projecting growth. Cotality, which used to be CoreLogic, is now projecting about a 7% growth in sales. Fannie Mae is expecting sales to grow by almost 8%. And the National Association of Realtors, who I think is legally required to have really, really optimistic home sales projections to keep realtors happy, is projecting about a 14% increase. And I'm also, with all due respect to their economics team, not buying into that one either. What I'm looking at is that I believe housing affordability will continue to improve marginally. That'll bring more buyers to the market. That could also lead to a better fix and flip market. Affordability improving and more buyers looking, I think, can only benefit fix and flip investors. I think mortgage rates will hold in the low 6% range and probably move slightly lower in 2026. I don't think we see rates get below 5.5% next year. I would be really pleased if we got that low, but I would not be surprised if we're in the fives. I think we are starting to see some of the first real signs of price weakness in the market. List prices are the lowest they've been in 3 years. We have a high number of list price reductions. It's taking longer to sell properties once they're on market. And the market has entered neutral territory, which means that sellers understand they have to negotiate in many cases in order to sell. Investors need to factor all of these things in and react accordingly, whether you're a fix and flip investor or you're a buy and hold investor. Inventory growth is slowing down, but continuing to build across the country. So there is more to choose from for both investors and traditional home buyers. And existing home sales are on pace to end this year between 4.1 and 4.2 million, which I think leads to sales of about 4.4, optimistically, maybe 4.5 million in 2026. And then, of course, this morning made a liar out of me. I said there was no update on new home sales and from the government due to the shutdown. And of course, they came out this morning when it was too late to change anything. So that's what I have. I will stop sharing my screen. Rebecca, Lori, Dave, thank you for giving me an opportunity to present today, and I hope some of this information was useful to the folks who were able to attend.
Rick, thank you again. Very informative, lots of information there. Just to let everybody know, because I don't know about you all, but I'll be watching this at least one more time in a replay, and then kind of going through the slides again as well, because that was a lot to digest. Thank you so much for all that information. I think, especially depending on the market that you're in, some of this can be absolutely invaluable, things that you really need to be considering and looking at. Overall, everybody needs to be looking at it, but some markets very, very much so. So again, we very much appreciate you. If you all just keep an eye out, Lori will send the replay as well as the slides out to you, so you will have an opportunity to kind of go through and redigest this again. A couple of the questions on the side were actually answered in the slides, and we are over time, and Rick is probably tired of talking, so I'm not going to submit him to that. And most of those that I see in the sidebar are actually answered in those slides. You'll catch it in the replay as well. So I really appreciate your time today. Have a great 2026. It's a terrific start to the year. Thank you all for being here again.